Welcome back, friends. So the question is that Donald Trump about to be sworn in as the president of the United States on Monday, January 20. Now, what can be the basic things that he can do immediately after he takes office, which can impact the world economy? Since his major target is immigration reform, expect deportations to start just within a day of his being sworn in as the president. The more important thing that one would like to one would like to hope that he's not going to go all out to put tariffs across the world on many countries. But that's what was a part of his pre-election manifesto. And it looks apparent that this is going to be one of his important ways of going about. Of course, there's going to be a lot of negotiation in the process. Scott Bessent, who is Donald Trump's Treasury Secretary nominee, endured his first congressional hearing on Thursday, being grilled about America's economic challenges. Even before he started, evidence had emerged that Mortgage Bankers Association had reported that the 30-year mortgage rate had jumped above 7%, following a 1% rise in the US 10-year Treasury yield since last autumn. This is not particularly punitive by the standards of financial history. Since 1971, the average mortgage rate has been 7.73%, and before 1990, rates generally sat over 10%. But the rub-off is that the US voters have become used to rates of 3% in the past decade. Such has been the low rate regime prevailing in the US of A. Indeed, the real estate industry had become so addicted to cheap money that people say that if the 10-year yields rise to 5% for any period of time from the current 4.65% level, then they can expect a string of defaults. And what is particularly notable and unwelcome about this development is that it has occurred even though the US Federal Reserve has loosened policy quite markedly since last autumn. Such divergence is highly unusual, and it implies that traders are blowing a big fat raspberry at the Fed. If you are an optimist, you might blame the strong US growth outlook for rising rates. A less upbeat explanation is that investors are bracing for price rises. While equity markets have rallied this week on better than expected inflation data, this could change if the President-elect Donald Trump follows through on his threats to introduce trade tariffs and mass deportations. As far as I understand, I think he's going to do both. Possible another explanation is that the Center for Economic Policy Research, non-US central banks are furtively cutting their treasury purchases. One factor that could be pushing long-term yields is that Bessent has rightly criticized Janet Yellen, his predecessor, for expanding short-term debt issuance. This implies that he hopes to sell more long-term debt. However, the most contentious and consequential issue is the US fiscal outlook. Right-wing pundits have warned for years that this is on an unsustainable track. On current trends, the debt to GDP ratio is projected to move from 100% to 200% in a decade, and the deficit is now running at over 6% of the GDP. In fact, that sparked Luke Gromen's influential The Three Rings newsletter to warn that if the 10-year Treasury yield rises above the nominal growth rate, then it is mathematically certain to quickly trigger a death spiral unless either or both the US rates are cut quickly or the US nominal growth is accelerated higher. More notably this week, Ray Dalio, the founder of Bridgewater Hedge Fund, published the first part of his analysis of historical debt crisis. He said he was deeply concerned that America will go broke and warns that a multi-decade debt cycle could soon implode. Thankfully, Dalio thinks this ugly scenario could still be avoided if radical reforms make the debt burden more sustainable. This could include cutting interest rates to 1%, letting inflation rise to 4.5%, increasing tax revenue by 11%, and slashing the discretionary spending by 47% or some combination. By implementing such a holistic policy will be tough though. And I'm told that some of Trump's supporters, such as Howard Lutnick, head of Cantor Fitzgerald, and the nominee for Commerce Secretary, insist that such market pressures which are there could be controlled. After all, the global financial institutions need to buy and own the treasuries, almost irrespective of price, to meet regulatory rules. And foreign investor demand for US debt still seems sky high, especially in places such as Japan. But a swelling part of this foreign demand is now coming from potentially flighty hedge funds. And you can see that all over. Thankfully, Besant seems to understand these dynamics well. Indeed, he told Congress that the reason why he left his quiet life as a hedge fund manager to serve in the US Treasury was because he feels a duty to tackle these fiscal measures and thus avoid Dalio's doom loop. But whether he has the political power or the savvy to do this is anyone's guess. He's certainly in race against time, so investors had better keep watching those treasury yields. I'm sure you're going to watch as well, just like I'm going to do. To get to know more where the US markets are headed, do join our Prime or Prime Plus Telegram groups. And to know more about the Indian markets, do join our Premium Value Plus, which is going to cover Trump's effect on the markets, plus pre-budget, how the markets are expected to behave. Or you can join Premium Plus, which is going to cover 10 to 12 days predictions in advance, plus give you Trump's effect on the markets, plus markets before the budget, on budget day, and after the budget, how the market will be. That will be covered in Premium Plus. Don't miss this opportunity and join them all at good discounted rates for you on the occasion of Trump's inauguration. Number to get in touch to join any of these groups is 982-086-1044. Happy investing. Take care. Bye-bye.